Even discussed rates and the potential impact that they could have on the market. The 10-year yield now the highest it's been since July of 2014. For more on that and the impact on your money is Jeffrey Sherman. He's the Deputy CIO at DoubleLine Capital, with us live today from the Inside ETFs conference down in sunny and beautiful Hollywood, Florida. Jeffrey, welcome back.
Hi, good to see you, Scott.
It's good to have you back. What do you make of this move lately in rates, and when do you think they're going to stop going higher?
Well, what you've said from the previous panel, you're talking about a synchronized global growth story, which portends higher rates. And so you're at a critical junction here on the 10-year. We're at this 262s, 263 level. We closed at 265 handle on Friday, which was above the highs in 2017. So you have some pressure on rates on the upward trajectory. The Fed has signaled that they want to tighten 3 more times in 2018. The market is starting to price that in on the front of the curve. Look at the 2-year. Continues, it's a little off today, but you're at like 207, 208 on the 2-year. And so what you have is just an upward move in yields across the entire Treasury curve, the 5-year as well. And so the only thing that's not corroborating this move higher is the 30-year yield, which is still sub 3 right now. So the one part of the market on the Treasury market that's holding out for this long-term bond bull market is the 30-year. But we are at these critical junctures here on the 30-year as well. And so it does look like rates will push higher.
About a month ago, Scott was out in L.A. and spoke to Jeffrey Gundlach. He talked at that time about investors being massively underallocated to commodities. And what you've witnessed here in the last 4 or 5 weeks is really evidence to that fact. We're seeing strong inflows. We're seeing the price action represent the need for both supply and the need for paper asset demand. What is your vision going forward for commodities on the remainder of the year?
Well, as you guys were just discussing, you're talking about a 3-year, I'm going on a 4-year low in the dollar. And so the dollar being, we think the next leg down, next direction is a leg down in the U.S. dollar. That's extremely supportive, or at least not a headwind for commodities. We looked at its valuation charts. I mean, there's one thing that you really can't disagree with, is that commodities don't look expensive relative to historical standards. So from a production standpoint, as you mentioned, there has been some underinvestment. We had about a 4-year consecutive bear market in commodities. That started to really turn in 2016, along with some risk assets. So we've seen investors start to really look at talking about commodities in their portfolio. But from a demand perspective, this global growth story is very accretive for commodities. You haven't seen supply really ratchet up. When you talk about the oil market, for instance, you have an increase in robust demand on consumption for oil, and you have a lot of supply problems too. Look at with Venezuela, they could disappoint in terms of their numbers. You're talking about OPEC perhaps actually hitting their curtailment and sticking together with their production cuts. So there's a lot of things that say commodities could have another leg upward. And historically, commodities have been a very good late business cycle asset class because you get this last push, you get a lot of leverage in the system, you get a lot of credit out there, and so you get this last boom that really resonates with the commodity market. So we think that commodities are one of the better investment vehicles, or at least have the potential for that in 2018.
Jeffrey, before I let you go, just give me the most attractive place right now to make money in credit is where?
In credit, I'd have to say still a little bit of the emerging market space. When you look at U.S. investment grade, U.S. high yield, although there's no default problems, we have a growth story. The spreads are at post-crisis tights in both those areas. So when we talk about emerging markets, the sovereign area is starting to look a lot more attractive than the credit market, the corporate market, simply because of on a relative value basis that spreads are not at post-crisis tights in the sovereign area. So that's one area that's been a bit overlooked when it comes to EM allocations. And again, as long as you don't have a big, strong dollar in 2018, which we really don't see, as the ECB is going to have to pale back some of these bond purchases. The market's starting to price in the idea that there actually could be a rate hike in 2018 from the ECB. And so when you look at the forward rate differentials, it really is supportive of a lower dollar, which still provides a tailwind to the EM space. So on the credit side, that's what we think is one of the better areas right now.
Good to have you with us. Give our best to your boss, Jeffrey Gundlach, all right?
Will do. Thanks, Scott.
All right.
Thanks, Scott.
We'll
Thanks
talk
for
to you
having
soon.
me.
You bet. Jeffrey Sherman is the Deputy CIO of DoubleLine Capital.